Hey everyone, and welcome back to another video for today. We are already in October. We have 3 months left in this year. So let's talk about 4 stocks you might want to buy or put on a watch list during the month of October. Now, over the past month, we have seen stocks go up quite a lot actually, despite September being a historically bad month for the stock market. We can see here that a lot of our favorite stocks, let's say, or stocks that are followed on here, are up double digits. Yes, there is of course some red as well, but over the last month we've done quite well. And year to date, of course, I think year to date has been quite an astonishing year again after 23 and 24. And so without further ado, let's go over and talk about the 4 stocks. These are the ones. I know MELI has been highly requested, especially because the stock has gone down heavily over the last couple of days. I hope you do keep watching, and if not, leave me a like and a comment. And of course, I'm only talking about these 4 names. That doesn't mean that all the other 10, 15 names that we do cover on the channel during live streams and other videos are not a good stocks to put on your watch list or actually buy in the month of October or maybe November or even December. I just wanted to focus on these stocks right here. These are also stocks that might not have seen that much movement on the upside over the last month. And so the value that you're getting might be better than another stock pick. So let's first start off with Mercadolibre. Mercadolibre, yes, I know. Everybody's waiting for a stock split because spending $2,246 for just one share is quite a lot, although I'm pretty sure that a lot of us do have access to fractional shares. Now, this is a company that is already worth $110.3 billion. Year to date has outperformed the market despite the recent drawdown in the stock price. It's up 27.2%. As you can see, the drawdown more recently has been, well, around 14% or so. Now, looking at Mercadolibre, of course, you could directly say, oh, it's super expensive. Look at the PE, 53.8 times, forward PE, 39.3 times, super expensive. I'm not touching it. Well, as I will show you, historically, this has always been an expensive stock. Why is that? Because it is an incredible company, great management, great track record, and it's still expected to grow very, very rapidly over the coming years. Here we're looking at top and bottom line growth above 30% compounded, that is. I'll show you the exact number, what's expected over the next coming fiscal years. Margin wise, this is a high margin business for now as well, despite some of the margins here getting hit a little bit as revenue grows faster than gross profit. Companies investing in its business to try and expand and make sure that its offerings is still best in class. Now, before I continue, if you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And of course, a special thanks to fiscal.ai for sponsoring this video. This platform right here, where you're seeing all of the metrics, all of the transcripts as well, is powered by fiscal.ai. If you want to go over the latest analyst conference at the start of September, you can just go here, transcript, you can read it all, or you can ask AI to summarize everything. You can even ask it specific questions about that specific transcript. There's a link in the description. You get 15% off. Also in the pinned comment, new users will also get Fiscal Pro for free for the first 2 weeks. Now, if you look at Mercadolibre's growth over the past 10 years, that is, revenue has grown at a compound annual growth rate of 41%. Yes, of course, growth is expected to slow down, but it's still expected to grow quite rapidly above 20% in fiscal year 26 and fiscal year 27. If you look at EPS growth, I mean, look at this. EPS is expected to grow 18% in fiscal 25, but then 49% in fiscal 26 and another 35% in fiscal 2027. Yes, to reach $90 per share. Of course, if there will be a stock split, these numbers will change, but that doesn't really change the value of the business. It just makes it easier to buy single shares and, of course, options as well. Now, as I said, this is a company that has always traded at a premium, right? If you look at the last couple of years, right? Last couple of years, you're getting here forward PE and now trailing PE. You're getting it today, of course, at a discount. I'm saying, of course, at a discount, but it's not that clear, right? Because this is a company that has seen its stock go up quite a lot over the last couple of years, but it has grown so much top and bottom line that it is becoming cheaper despite the stock going up. On average, forward and trailing were much higher than where we're at right now. We have here a trailing PE of 55.4 times and a forward one closer to 40 times, as we've seen, which of course is lower than the last couple of years on average. The business can be split into a couple of segments, but the reporting segments are here commerce revenue and fintech revenue. But with Mercadolibre, you have, of course, the e-commerce side of the business, fintech, logistics, loans. Of course, it is an amazing business. You can definitely call it the Amazon of Latin America without the AWS part of it. Of course, you can say, yeah, but AWS is probably worth $1 trillion or so. I would agree. But that's why Mercadolibre is worth $110 billion and not $3 trillion. If we look at what has happened margin-wise for the business over the last couple of years, yes, gross profit margin has come down. Revenue has gone up quite significantly. Right now, we're still sitting at 51.5%. Free cash flow margin has been around the same levels for the last couple of years, around 30% or so. And this, of course, is an incredible margin profile for a company that is still growing quite rapidly. Now, more recently, what has happened with the stock? Why is the stock down so much, let's say, over the last couple of days? Well, first of all, Amazon announced it would waive fulfillment by Amazon fees and slash sales commissions for third-party sellers in Brazil. This effectively makes Amazon's platform free for sellers for a period, a direct challenge to the fees charged by Mercadolibre. But if you remember, Mercadolibre also lowered their own fees. Now, by making the cost of selling on Amazon zero, the company aims to rapidly onboard sellers and instantly increase the variety and volume of products on its platform, which is the fastest way to challenge Mercadolibre's dominance and network effects. Now, okay, fine, but just so you know, Amazon has been trying to challenge Mercadolibre in those core markets since 2012, and it's fair to say that it has been unsuccessful to make sure that Mercadolibre does not succeed. Maybe this time will be different, maybe, but I'm betting on the opposite. Then we have more of a macro impact or potential impact on Mercadolibre and of course also on Dlocal. So we have to talk about Argentina. Since Mercadolibre and Dlocal are operating in those areas, we have to talk about that. So first of all, GDP growth in Argentina. It's in a solid recovery with GDP up 5.8% year over year in Q1 25. This is driven by surging investment, private consumption, and exports. The monthly inflation has also fallen sharply to around 1.5%, which is a huge victory that is strengthening consumer spending power and improving market stability. Unemployment is stable at around 7.9%, and poverty has dropped to 38%, with extreme poverty around 8%. These improvement metrics suggest that the economic reforms are starting to take hold and benefiting the broader population. Mercadolibre is backing this recovery with a huge show of confidence, planning to spend $2.6 billion in Argentina in 2025 to boost logistics, tech, and hiring. Now, we also, of course, have another side of a story here. So, more recently, we've heard about the $20 billion swap line from the United States to stabilize Argentina's dollar reserve. The purpose of this is as follows. This US support is designed to provide short-term stability for the peso and the country's limited hard currency reserves, which are critical for financial stability. The deal is not purely economic, it is a direct move by the US to curb China's growing influence in Latin America. The US is using the swap line as leverage, pressuring Argentina to limit future soybean exports to China, its major trade partner. The announcement did give Argentine bonds, the peso, and stocks a short-term boost, but the market remains cautious. A key risk is that if the US demands are too strict, they could complicate trade and potentially lead to a negative response from China. Now, China has previously already offered Argentina an $18 billion swap line and is the largest buyer of Argentine soybeans, which gives, of course, Beijing a significant economic leverage. Now, the US dilemma here is by conditioning its support on Argentina's restricting soybean sales to China, the US is entering a sensitive agriculture policy debate. This creates internal political controversy in both countries and highlights the intense Washington-Beijing competition for influence in the region. There are also elections coming up in Argentina, and of course, Argentina is a part of Mercadolibre's business, Dlocal's business as well, and with uncertainties around that country, around that economy, yes, that might have an impact on Mercadolibre. although Mercadolibre in the past has gone through worse conditions, I would say, in Brazil, and look at where it is right now. Lastly, we also had a quick comment from Morgan Stanley. They have an Oro rate rating with a price target of $2,850 on Mercadolibre. MELI shares are down 13% in 2 days, with simmering concerns around competition, reinvestment, and macro all bubbling to the forefront. We believe the move is outsized relative to new developments and reiterate our preference for using stock dislocations to add to a long-term compounder. Couldn't agree more. Oh, and by the way, at the time of recording this, as you can see, Mercadolibre did go under the 200-day moving average, but then we quickly saw it recover to stay above it. Before we move on to Dlocal, just wanted to show you that the probability of another 25 basis points rate cut in October sits at 97.8%. That's up from 85.5% just a week ago. Moving on to Dlocal. Yes, Dlocal has been featuring a lot more recently, and that's for good reason, because Dlocal, despite it being up 20.3% year to date, over the last 12 months is up 63.2%, but over the last 3 years, the stock is still down 33.8% despite growing top and bottom lines. This is a company that is still only worth $4.1 billion, has a trailing PE of 29.3 times and a forward one of 19.5 times. This is a company that is small, profitable, and fast growing. Yes, it is operating in emerging markets, so you will have sometimes some fluctuation in the FX results, whether it's in Africa, Middle East, or Latin America. Now, during Analyst conference at the start of September, they said the following thing on non-LATAM growth. Africa, the Middle East, and Asia now represent nearly a quarter of the business and are growing significantly faster than LATAM, contributing to higher take rates and reduced market dependency. Of course, as this company grows and grows and grows, they're less dependent on one specific country that has maybe been seeing some fluctuation in its currency or economic struggles, the up or downside when we talk about FX here. Gross profit dollar growth, TPV growth, has consistently offset take rate compression, leading to accelerating gross profit dollar growth. There was, of course, some fears about, yes, the take rate is coming down, but they've been talking about that for quite a while. Yes, take rates are coming down, but they think that TPV growth is going to be more important, and they see TPV growth actually offsetting a lower take rate. It's all about gross profit dollar growth. And as I said previously, this is a fast growing company. Look at revenues compounded annual growth rate over the last 5-6 years or so, 51.5%, still expected to grow above 20% for the coming 2 fiscal years. EPS is also expected to grow quite rapidly. Operating income is expected to grow quite rapidly over the next coming years. Gross profit margin. Okay, here you're seeing gross profit margin come down. How is that possible? As I explained in the past videos, revenue growing faster than gross profit, then of course, gross profit margin for now is dropping. But the problem was this. The problem was gross profit margin coming down while gross profit was also coming down. Then we've seen it recover, right? We've seen gross profit dollars continue to go up, while yes, gross profit margin is coming down. Again, revenue growing faster. Looking at revenue, where do they generate the revenue? As I've just explained, the majority is still Latin America. Then we've got non-Latin American countries. I do expect the blue bars to start growing a bit more. As for net revenue retention rate, we've seen it bottom at 100% in the June quarter of 2024. Since then, it has been recovering, and as of last quarter, that was 145%. Lastly here, TPV last quarter, that increased 52.6% and it has been increasing above 50% for the last 3 quarters. And yeah, this is amazing. This is a company, again, that is very, very small, that is operating in a huge, huge market. If we look at the global south, it is a huge market. Dlocal, a very small player, but a small player with a huge opportunity to become massive in the future. They have a tremendous good CEO, Pedro Arnt, previously CFO of Mercadolibre. They talk a little bit more about him specifically in another video on the channel. It's one of the main reasons why I am so optimistic about the business. Yes, sometimes it is just that simple. Good company, fast growing company, profitable, small market cap, big market, and an extremely good leadership team. Right now, looking at the stock, we've had a nice increase after, of course, the amazing earnings report. Since then, we've seen the stock drop all the way down to around $12.50. This here happened after they announced a secondary offering. Overreaction, I added more shares here, as you know. Then we had a nice recovery all the way back to $15.6, and now a small pullback. Could we go and revisit the 50-day moving average at $13.30? It's possible. It's possible. If it will happen, I'll, of course, accumulate more shares. Moving on to SoFi, I'll quickly touch on my strategy with SoFi because you know it's a pretty big position for me already. I just covered SoFi over the last couple of days, especially after the stock did drop a little bit, right? We've seen the stock drop a little bit over the last couple of days because of a note coming out, which was already corrected, talking about Upstart, talking about delinquencies and all of that. And they corrected themselves. Actually, it's not that bad. Okay, thank you very much. It's not that bad, but you just caused like billions of dollars in market value to evaporate after you've released your note. So quite ridiculous if you ask me. But anyways, SoFi sits at $30.8 billion in market cap, share price close to $26. Yes, if you look at the PE right now, oh, it's super high, but let's not look at the PE for now. You can look at it when it's more mature of a business that is not really growing that fast. Plus, these growth projections right here are a joke. I still expect SoFi to comfortably beat their own expectations for the next quarter and of course their 2026 EPS targets as well. Midpoint of 67 cent or so EPS. The market still thinks it's only going to be 55 cents or so. Market has been wrong for the last 3 years, so I guess they'll be wrong for another 3 years or so. Right now, the stock, as you can see, yes, is pulling back. It's getting quite close to that 50-day moving average at around $24.90. Would it hold? I'd probably say yes. We know that at the end of October, they're going to report their quarterly figures. I believe it is October 28 before the market opens. Of course, we're going to cover that as well. Me personally, if we do see the stock drop below, revisit maybe here the 100-day moving average at $20. That's probably going to happen only if there is a market correction or pullback. I'll accumulate a lot more shares. Right now, I feel very comfortable with my position, but if it becomes too good to ignore, because it still is an amazing company, I still think that this can become a $100 billion business in the future, then I'd be a fool not to add more shares if we see or if I see a very, very good opportunity. And I'll repeat again, for those that want to use the PE ratio, the forward PE ratio, these are the current expectations for SoFi. This, in my opinion, is just too low. And so if you change this to, let's say, 70 cents, you're of course going to get another forward PE, a cheaper one in this case. I think SoFi will continue to beat the market's expectations, will continue to grow much faster than what the analysts are thinking it's going to grow at. It's going to be more profitable. And yes, we are also going to be included in the S&P 500 whenever that will happen. If you look at what has happened with Robinhood, Robinhood stock, of course, went up on the announcement that it got in, and Robinhood got up the day it actually got in. So yes, those are stock catalysts. But business-wise, the business is doing extremely well. We have a very, very good business in the loan platform business, fee-based revenue, high margin, low risk or lower risk fee-based revenue. That's going to be an incredible business. For SoFi, we have level 1 options coming out right now, rolling out to all members. Okay, it's a nice to have, of course. If you want to be that one-stop shop, it's of course a nice to have. We're going to have crypto come back to the platform, also an added value. So there are still plenty of tailwinds for SoFi. We're not at the end game yet, far from it actually. Moving on to the last one here, and that's Adobe. It's a name that I do not own. It's one of those value plays, maybe recovery plays out there that, yes, I do think will beat the market in the coming years, despite the stock not performing very well, right? Over the last 5 years, this thing is down 26.6%, and year to date, it's down 20%. It's getting the same treatment as PayPal, although PayPal right now is not really getting the, oh, you're not going to do anything with AI, and so we're taking the stock down. Adobe is AI is a threat to the business. That's the current feeling of the market. But so far, it's not really showing. It's a company worth $143 billion, a trading P of 21.4 times, forward PE of 15.1 times, amazing margin profile on the business, gross, EBITDA, operating, net, free cash flow margin, amazing across the board. It's still expected to grow, let's call it low double digits, revenue and EPS. And yet, stock isn't moving much. If we look at the commentary, the last quarter, 10% growth year over year, record revenue, $5.99 billion. Digital media revenue, $4.46 billion, up 11% year over year. Digital media ending ARR of $18.5 billion, growing 11.7% year over year. Remaining performance obligations, $20.4 billion, growing 13% year over year. They said the following thing: Adobe's AI strategy is yielding significant results, with AI-influenced annual recurring revenue now surpassing $5 billion, a substantial increase from over $3.5 billion exiting fiscal year 24. Furthermore, ARR from new AI-first products, including Firefly, Acrobat AI Assistant, and Gen Studio for performance marketing, has already exceeded the full-year target of $250 million ahead of schedule. This was a number that Adobe gave us at the start of the year, and they thought this is going to be enough to convince the market that, look, we have AI revenue and all of that. But in my opinion, this was just a number that was too low, right? For a business that generates close to $6 billion a quarter, what's $250 million for a full year? Not a lot. But okay, they beat those estimates, which, let's face it, expectations were quite low. And so overall, while the market right now still believes that AI will destroy this business, I am not seeing any cracks in Adobe's business just yet when it comes to revenue or when it comes to the profitability side of it or free cash flow side of it. I don't see any cracks in the business. One thing that is coming down quite rapidly is, well, the shares outstanding. This is also something that we've seen with PayPal. If the market wants to keep the shares down and extremely cheap and the company still generates billions of dollars in free cash flow, then yes, shares outstanding are going to come down, which of course is going to be quite good for long-term investors. Of course, if eventually AI does destroy Adobe's business, then it doesn't really matter if they bought an insane amount of shares. But so far, we're not seeing any cracks in the business. And I mean, when you look at these things, these numbers, free cash flow margin, gross profit margin, revenue growth of the last couple of years, of course, here we're showing over the last 20 years, but just look at the last couple of years, 5, 10 years or so, where are the cracks? The cracks are not showing, or at least they're not showing up just yet. And if we look at the stock right now, the stock did try to stay above the 50-day moving average, did not succeed. Right now, we're still under it. It is at $354, the 50-day one. The 100-day one sits at $373, and the 200-day one sits at $393. It is very cheap, in my opinion. Am I going to buy it? No, just going to follow it and cover it more. And so all in all, that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, you have any specific companies you want me to cover over the following month, let me know down in the comment section below. Do check out fiscal.ai to get 15% off. There's also a link in the pinned comment. See you all in the next one. Bye-bye.